Welcome to Real Vision's Trade Ideas. Today we're sitting down with David Levine of Odin River. Great to have you here.
Thanks for having me.
So you're known a little bit as a paranoid bull. Given that we've had a recent pop in the markets, what do you see going on? Is that going to last?
Well, thanks for having me back. The first time that I was on was actually about a year ago, and we talked a little bit about political risk in Italy. And then I made kind of not a great call on German bonds, although the fundamentals of the political risk environment that underscored both of those ideas is still very relevant today. So I think that what we've seen is that 2018 was a fairly rational market. 90% of asset classes were down. Q4 2018 was the worst quarter since prior to the dot-com bust for the largest pension fund in the world, which is GPIF in Japan. US equities, people probably know, were pretty bad in December. But then from January through kind of, let's call it just the last few weeks, we experienced what's called a bear market bounce or a return of the bull market, and that's a debate. From my vantage point, I think that what we saw was really more of a bear market bounce, and that the reason for that is the central banks between Powell, Draghi in Japan, the BOJ, in addition to the monetary authorities in China, acted pretty aggressively to hope, and to succeed in getting markets to bounce. That was also then kind of coupled with positioning where people had done very poorly in Q4. And so once they started having good performance in January, people were focused on monthly returns. They thought, oh, this is going very well. Let's keep doing more of the same thing. And so momentum kicked in. However, if we look back to where the markets are today, which is roughly where they were at the beginning of the year last year in January of 2018 and where they were in September of 2018, one thing that is clear is that the fundamentals are actually way worse. And the main risk or systemic risk in the system, which is political risk, is also way worse. As of a few weeks ago, people thought maybe that President Donald J. Trump would save the entire world with a trade deal with China. Clearly, probably not going to be the case in the immediate term, even though a few weeks ago, somehow we all had belief that President Trump, through tweeting, would save the entire financial system, which is kind of an absurd idea if you think about it. However, when you look at fundamentals, end markets from automotive, which are down 10% year over year for the last few months in China, PCs have declined, smartphones have declined, and because of that, industries like semiconductors have declined massively in the first quarter of this year. Also, S&P 500 earnings were negative year over year in the first quarter of this year. So fundamentals now are worse than the last time markets were at these levels. So my own view, yes, I am a paranoid bull. I've got a Twitter account called Paranoid Bull on Twitter, but I am a long-term optimist. Odin River is about that. But in the near run, I'm very concerned about equity markets across the board. So I think the S&P 500 and the NASDAQ and the US equity markets have quite a bit of downside, more today than they did in the fall. And within that, certain sectors where fundamentals have gotten extremely bad, like automotive and semiconductors, I think there's also more downside than there was last time markets were at these levels.
So do you see this as something that's simply short-term, or do you see this as a long-term secular bear market that we're going into?
So there's this phrase that I use on Twitter, which is cycles matter. And the reason why I say that is the philosophy of Odin River is really two things. Progress is inevitable. So on a secular basis, I'm actually very optimistic. However, cycles matter. And what I mean by that is the credit cycle and the business cycle, and now unfortunately a systemic risk cycle, is more important in the short run for prices. So the short answer is a short run move, meaning a month or a week or a day. It's a very hard thing to predict, although most of the investment business now has been transformed to focus on that, which is a little absurd. It also helps to explain why we get moves like we do lately. So I'd say that I believe that 2018 was the beginning of a normalization that will take time, resulting from 10 years of systemic risk mispricing and the biggest credit bubble that we've ever seen in history by almost any measure, whether it is total debt to GDP, whether it is total debt in the system. Yes, U.S. households are in better shape, but the corporate sector specifically, in addition to governments, which is the most important risk in my opinion, in the system, have had more debt issued than ever before in history. In addition, the prices of asset classes from equities, on any kind of adjusted basis, whether Shiller PE or when you look at revenue multiples, which adjust for peak margins, have also become very high. And even if we look at, and if we ignore that margins are at peak and we look at current earnings multiples, the multiples are still now back to higher than they were in September, which is one of the reasons why I think there's more downside today. So the short answer is, I am a secular optimist, but I do think there's more downside, more than just a week or two. This isn't kind of a short-term thing. This is a continuation of what began last year. It seems that we need to, in my opinion, have a proper bear market. We need to have credit defaults pick up. We need to have bankruptcies, and likely systemic risk could emerge, potentially, most likely in Europe, but it could emerge in other places. Now, how will that materialize in prices? Unfortunately, it's hard to know exactly where things break. Again, I think Europe is most likely. I was clearly wrong about Bunds. We'll see about, over the long run, whether that changes. Italy, again, I still think is the most likely country within Europe where systemic risk can emerge in prices. However, it doesn't necessarily matter for markets exactly how it emerges, meaning fundamentals are already bad. And so companies' earnings are declining. The fact that prices might fall in equity markets and credit markets might have defaults, whether or not systemic risk pricing shows up in government debt, has already become very clear. So as we enter a more volatile period where equities are down, where credit markets are correcting, in that environment, it seems more likely that systemic risk will emerge in things like government debt, where volatility will emerge in things like the treasury market. And if that starts to happen, the banking system is way more exposed to government debt today than they were exposed to the subprime mortgages through CDOs last crisis, because government debt, because of the myth of the infallible central bank, is actually held on every bank's balance sheet. In Europe, you don't even have to use risk weightings for government debt on your balance sheet. And so I think that, the short answer is systemic risk has been mispriced for 10 years. Political risk in government debt is the most obvious example of that. And we see systemic risk actually already evident in the fact that our society is being ripped apart, for instance, by populism. How it will materialize, we'll see. We'll see. But for our purposes, unfortunately, today in the financial markets, fundamentals are bad, multiples are high, earnings are rolling over, and so therefore, we can hedge against systemic risk just by shorting companies that are overvalued, which is ultimately what investing is about, in my opinion, is value investing.
All right, so let's follow up on semiconductors specifically.
Yeah.
So when we reached out to get you onto this program, you were looking to short semiconductors.
Yeah, that's
and
right.
that so far has played out quite well. They're down since then. But given that drop off, would you still consider shorting them now?
Yes, and so the reason is, again, if we look at the broader market as an example, what happened was that as of last September, semiconductors are roughly today where they were last September. Now they had, when you contacted me a few weeks ago, had gone past the peak of where they were last September. What's very interesting about semiconductors as opposed to the rest of the market is the earnings have actually gotten way worse in semiconductors than many other sectors since then. Q1 in 2019 had one of the worst performances of semiconductor earnings in history. March, sequentially, from February to March, had the worst sequential performance of semiconductor sales in history. So we actually have, in the most recent data, some of the worst earnings performance that's ever happened in semiconductors, yet the stocks went way up. Why is that? Why is that? Well, the reason is there's a narrative. There's a couple of narratives. There always needs to be a myth or some kind of mistaken assumption for prices to go up. And semiconductors, it's kind of a combination of really two things. The first is the back half magic. Don't worry, even though Q1 earnings are bad, Q2 earnings are actually forecasted to be worse. Gross margins are being compressed across almost every company in semiconductors at a point that's quite bad. On earnings calls and also in kind of the market sentiment, there's been this hope, don't worry, the second half of the year is going to be okay. Now, at least as of a few weeks ago, some of that assumed that there'd be some trade deal with China or something, that don't worry, by the second half of the year, everything will be okay. It's actually true for S&P 500 earnings too. If you look at Q4 earnings, there's forecasted resumption in growth. But within semiconductors, there's been a hope that the second half will be better. I do not think that's true. And the reason is that 2018 was a peak of semiconductor earnings that has been way higher than previous peaks. Margins have been higher than previous peaks. Part of that is because in 2015 and 2016, when the cycle tried to turn, central banks did not let it. And so we kind of got a very big upcycle in semiconductors. Therefore, I think it will take quite some time for earnings to recover. So the short-term run-up was partially based on the overall market. Semiconductors have a high beta, so people are allocating to that, partially because of a belief in the back half rally. There's a third thing, which is what I'll call overly optimistic short-term earnings. And what I mean is I'm a big optimist about autonomy, and I'm a big optimist about many of the trends that semiconductors are ultimately exposed to. However, those are very small components of the market today. So if you look at semiconductor earnings, they're primarily based on things like PCs, cloud computing, smartphones, and cars that are sold today.
And Bitcoin.
We should talk a little bit about the Bitcoin exposure of some of the GPU manufacturers, for sure. And that's a good point. In gaming, of course, is another example. But most of the end markets, and Bitcoin aside, and some of the bounces in Bitcoin, we can talk about that if you're interested. But I do think that the end markets for semiconductors have slowed down. That's why earnings are down, right? Mm-hmm. So we're not really hypothesizing about the future. We're talking about today, which is the end markets are weak across almost all end markets that semis are in. And when people get overly optimistic about the future in the near run, what they're doing is they're using this idea called content growth, which is a very good thing, meaning if I sell semiconductors to car companies, in the long run, there's going to be more semiconductors in cars because of autonomous vehicles. And that's true, right? But in the immediate run, autonomous vehicles are about 0% of cars today. Let's call it electric vehicles, which are way faster or kind of more near term than autonomous vehicles, are 1% of electric cars today. So if you take auto sales, which are down 10% year over year in China, they're declining around the world. If a market declines 10 or 20%, the units that you're selling into that market will decline 10 or 20%. In order for you to make up for that in content growth, it's actually almost impossible if you're selling into a small part of the market, right? So if you have say you're selling 100 units at $10 and that goes down 20%. If you then sell of the 80 remaining that you're selling, if you sell 20% more content for 10% of that, it doesn't even begin to make up for the decline in units. And so what happens is these very kind of compelling long-term narratives about content growth become, I think, overly emphasized in the near run because we're all optimistic, and hopefully we're all optimistic in the long run. So those two mistaken assumptions, one is a back half recovery, and the two is kind of, I call it overly optimistic short-term assumptions about content growth, have caused people to be overly optimistic about semiconductor earnings. And so therefore, we can be short these companies based on fundamentals, notwithstanding all the other issues, including systemic risk, the underlying cyclicality of the economy, and other things. And that's why it's particularly interesting.
And then on top of that, there is political risk in a certain sense with the whole Huawei thing that's going on, where it looks like the U.S. might ban a lot of Huawei technology from the U.S. overall.
It's a very good point, and of course, I think that's exactly right. And so whether we look at the specific ramifications of Huawei, whether we look at things like Qualcomm and other industries, whether we look at China looking for alternative sources, to U.S. companies for their semiconductor needs, that is another political risk. Mm-hmm. Fortunately, given earnings outlooks, we don't even need to believe that. It's what's so great about saying it's great to short something maybe isn't a good thing. I think it's important to preserve capital in this environment, and that's why it's good to look for shorts.
So how would you go about shorting the semiconductors? Are there certain levels that you're looking at? So
for me, I tend to focus on individual security names, but rather than picking on a particular company, I think it's okay to look at the SOX index, and then there's an ETF for folks called SMH, which is basically a derivative of the SOX index. I think that if we look at kind of, again, going back to January of last year, and then September of last year, and then today, what we see is that the index is relatively close to where it was at those previous peaks, local peaks, which are way higher than if we draw the graph back and look at history. We can see then that January, last September, and then May was way higher, even higher, but even today, now that the stocks are down a bit, we're still at an elevated level. In December, we kind of began to break through long-term resistance, and so semiconductors had started to, as an index, the SOX index or the SMH, which are relatively high correlated, had started to break down and break through kind of historical resistance levels, but we didn't quite get through the resistance that I think is necessary. So I think that actually the downside is lower than where we were in December, meaning that once the SOX and the SMH indices pass where we were in December, we could begin to kind of think that the indices have started to correct to a more normalized level. For me, I tend to look at the individual company earnings, and so like I'm expressing this similar thesis based on fundamentals or companies that are components of the index. But looking at the index as a whole, we can capture somewhat of the same thing,
Sure.
which is the cyclicality of
So
where we are.
what individual stocks would you be looking at here?
So I really don't like to pick on individual companies. What I would say, though, is that I will pick on one, which is Micron. Even though I have friends who are long Micron, I think it's a very good company in the very long run. Unfortunately, if you look at Micron on a longer time scale, if you look at the earnings of the company, they've really kind of been inflated quite significantly by some smart moves that they made. So what happened, Micron bought a company called Elpida out of bankruptcy last cycle. Very interesting, very strategic on the long side. It was actually quite good to be long Micron for a long time. However, because of that, the industry structure got to the point where earnings were very high and they were inflated in a major way. So a lot of people look at Micron and they look at book value. And they're like, okay, well, Micron can't really trade at much lower than book value. The problem is that Micron earned almost its entire book value in 1 year, going through from 2016 through 2017 into 2018. They doubled their book value. And the reason is because margins were very elevated. In my opinion, the right way to look at a company that's cyclical like Micron is you need to adjust for that. So the book value that people use when they look at Micron, in my opinion, is overstated. Not to mention Micron's, we have the political risk point you mentioned, exposure in China, which is quite elevated, but also their exposure in some of the end markets that are really slowing down. But really a lot of these companies are kind of exposed to some of the same factors. Micron's also one where people have quite elevated expectations for the second half of the year. And so it's one that is kind of a highlight of some of the things we've been talking about. But many of the semiconductor companies would kind of fit the same.
And you would look to short at current levels?
Yeah, I think current levels. And one way of thinking about it is if you look at, kind of the book value, which is in the, low 30s, depending on how you look at it, a lot of people don't think it can trade kind of below book value. I think that book value multiple is actually quite wrong. So if you adjust the book value, say in half, or however you want to adjust for it on a cyclical basis, you can see even if we kind of look at it on some kind of intrinsic book value basis, there's quite a bit of downside. Earnings today are declining. So looking at current earnings, they're going to continue to decline in my opinion. So the multiple will be quite elevated on current earnings, especially if they begin to burn cash again, which seems quite possible in the second half of the year if I'm right about fundamentals. So the earnings multiple becomes very high if that happens.
Over what time horizon do you see this playing out?
So again, I think that it's begun already. When you're shorting things, it's good to kind of wait for markets to begin moving in the right direction. And so in this case, it's begun. The timing is really now. I think that it seems quite likely that what's important again is whether or not we get a back half recovery. So where could I be wrong? If we get a trade deal, if the economy reaccelerates, if in markets from smartphones to automotive to PCs and cloud computing reaccelerate, if all those things happen, I could be wrong. And so what is very important is to pay attention to the fundamentals of semiconductors, which by the way, in South Korea, we had 30% year-over-year decline in semiconductor shipments coming out of South Korea last month. So it's possible that's temporary. But if, for instance, some of these fundamentals change, then that's where the thesis could be wrong. So the timing is to continue to focus on near-term earnings forecasts. Again, next quarter earnings, we're going to get a lot of information. I would imagine that the next quarter earnings, we're going to have to see full-year numbers continue to come down. But again, if the broader market has the type of environment that I expect, then over the next, call it, few quarters, this should continue to play out.
How much more potential downside do you see there being for the semiconductor industry?
I think that if you look at historicals, there's at least 30% downside, from here. And then, whether it goes beyond that, we'll see. It just depends on whether or not systemic risk emerges in the way that I think it will, or whether or not I'm wrong and that, these companies can reaccelerate earnings in the back half and that, the economy can, be more resilient on a global basis than it seems likely to be.
Great. Can you break down this trade thesis in 30 seconds?
So I'd say that, the overall trade thesis is to be short semiconductors as an expression of, the end of the cycle, which actually began in 2018. And the reason for that is earnings have already turned negative and multiples are elevated. And we've already started to see the trade beginning to play out, which is always good. So I would be short semiconductors either in an index like SOX or SMH, which is an ETF of that, or individual names. I'd look for the next 1 to 2 quarters at fundamentals. If they continue to deteriorate as I expect, then I expect over the next kind of 3 to 6 months that we have 30% downside or more across whether the indices or some of these individual securities. And so we should see that play out in the next period of time.
Great, David, thank you so much.
Thank you.
So David is bearish on semiconductors. Specifically, he likes shorting the Van Eck Vectors Semiconductor ETF, ticker symbol SMH, at current levels. He sees 30% downside risk over the next 3 to 6 months. He also recommends shorting Micron Technology, ticker symbol MU, at current levels. He sees 30% downside risk over the next 3 to 6 months. Just remember, this is a trade idea and not investment advice. You should do your own research, consider your risk tolerance, and invest accordingly. For Real Vision, I'm Justine Underhill.